So today I want to talk about the game we're all being forced to play. And this game has to do with the stock market. Whether we like it or not, we are forced to buy into it in order to protect our purchasing power over time. And this game is so complex. There's so many different ways of buying the stock. There's so many different strategies for trying to predict certain outcomes. And it's overwhelming, I think, for most people. One of the things my parents always told me about the stock market, which is actually true in the short run, but maybe misleading for the long run, was, it's essentially a casino. People are making bets on companies and they're using ownership. So stock's just proof of ownership that you own a certain company, a slice of a company. And all it is, fluctuations day to day based off how people feel about that company. So if they feel particularly bad one day about, Apple, for example, stock will go down in price. Does that mean you lost any value? I don't know. I think it's because of this complexity that the education system doesn't really go into any detail on how stocks work or what they even represent. Because there's just an ocean of different ways of consuming those investments or trying to make a story as to why one stock is better than the other. And the truth is, it's not an exact science. It's based off psychology. What are investors thinking that company is going to do in the future? And, they're going to create a price based off a belief that hasn't occurred yet. So it makes it very difficult to understand at a micro level, like what are these stocks even worth? I think even a true stock expert that does this like every single day and has done it for 20 years will tell you, no one really knows what the stock will do, one day to the next. One thing to remember about stocks themselves is what they actually represent. They represent ownership in a company. And hopefully that company is providing a service or a product or value somehow that is being monetized. And what makes a stock so valuable is that these are essentially money printing engines, right? These print value by delivering those services, and you as a shareholder are entitled to that value as your company kind of grows. And that's the important thing to think about here is capitalism is not built for workers. It just isn't. We can pretend like we can twist it and try to make it better for the workers, but worker is just a commodity. We're all just commodities. We have a certain skill set that we could charge for, and we trade our time for money because that's how we add value to the economic system. What you want to do is get out of that as soon as you can. You want to become a shareholder because that's what capitalism is built for. It's built for the shareholders. I'm not saying that's fair. I'm not saying that's right, but that's just the reality of it. So the sooner you could become a shareholder and the fact that you own something, you're getting paid for it, that's the route you want to take. And while buying individual stock is one way of doing that, it's inherently risky because a company can grow and become massively successful, but then in 10 years it could completely collapse. And you as an individual have no way of knowing that. Even professionals, I think, struggle with that. Some examples, Xerox was once one of the most valuable companies in the world. Have you used Xerox for anything? I haven't. Yahoo was the leader of tech at one point. It's not anymore. So these things are constantly changing. And the only way to protect yourself for that change has been this strategy of buying index funds. So to keep this video from being just obscenely long, when I say index funds in this video, I'm talking specifically about the S&P 500 index fund. In order to understand index funds, let's start with the phrase. So the first part of the phrase is index. What is an index? It's just a list. And in finance, there are a ton of lists, but some of the more popular lists are the S&P 500 list, which is the top 500 companies by market cap. Market cap is just the value of the stock price times the number of shares that are outstanding. Second part of the phrase is fund. And all fund means is a pool of money. So index funds are a pool of money that buy stocks in a list. So why do index funds exist? Well, it's to simplify the act of buying into the stock market. You don't have to think about it. These lists are not created by humans per se, in that there's not someone making decisions typically on whether a stock deserves to be in the list or not. It's purely quantitative. As companies get bigger, they get added to the S&P 500. As they start to get smaller, they get taken off the S&P 500. So there's no decision making, which makes it a very cheap vehicle to buy and sell stock. The index fund was invented in 1976 by Jack Bogle, who was the founder of Vanguard. And the whole point of the fund was to simply match market performance rather than try to beat it. And what he knew back then was having a broker make and make buy and sell decisions was an expensive endeavor. You had to pay the broker, they had to do research, they had to look at financial statements and try to build a case for why they wanted to sell or buy. And sometimes they were wrong, and this caused the funds to do worse. So rather than try to work to outmaneuver the market, he had the idea of just setting up this, well, let's just match the market. And maybe that level of return is good enough for a lot of investors. What ended up happening was the market was outperforming most active fund managers, primarily because of the fact that you didn't have the fees to worry about. So no matter what, no matter how how actively managed funds performed back then, they had to overcome the fees. And these are highly compensated people making these decisions. The index funds didn't have that, and they outperformed active managers. So you think it would be in Jack Bogle's best interest not to create something like this, and for him to continue charging services for buying and selling stock. Well, ultimately, it helped him in the long run. Vanguard exploded. It's one of the biggest, if not the biggest, I think it's like number 2 by AUM of investment management companies in the world. And so people kind of understand the passive option, and they invest heavily in it. And it's one of the most popular options in most 401k plans. Funny enough, the personal finance industry continues to downplay the effectiveness of index funds. And you see this much more with commission-based financial advisors versus fee-based financial advisors. But they will try to convince you, hey, if you work with me, I will help you beat the market. And it's just not realistic. I think the latest figures were like less than 20% of actively managed funds are actually able to beat the market. And chances are they're not gonna manage your money. You don't have enough money to get with those kind of guys. Or, maybe they're able to do it for a period of 10 years, 15 years. But then things go south. Maybe the main manager retires and someone else comes in and he's not good enough or as good as the last guy. So you have no idea how to control for that, and you're paying a fee on top of that for these. So index funds have been hugely successful because they don't try to beat the market, they just are the market. So let's talk about the pros and cons. The obvious pro again is the cost. If you look at your 401k options and you look for something called expense ratios, you'll see that index funds are pennies on the dollar compared to pretty much all your other options. So that's number one. Number two is really the tax efficiency. So a lot of funds have something called turnover. And what turnover is really buying and selling decisions. And depending on the fund, that may happen once or twice a year, or it could happen all the time. Every time you have one of those events, it creates a tax event. So if you're doing it in a 401k, that doesn't really affect you. But if you own this fund in a taxable brokerage account, all of that adds up. So you have capital gains, which is the growth of the stock value over time. And depending on how long they held the stock determines what type of capital gains it is. So there's not enough time in this video to go over tax strategies, but just understand that the more activity you have, the more taxes are created. Besides tax efficiency, you have another benefit in the sense that you are buying a large swath of different companies. In the case of the S&P 500 index fund, you're essentially buying 500 companies all at once with that, $1,000 contribution. So let's talk about cons for a minute. As much as I love index funds, there is an inherent weakness in the fact that you are buying the market. For better or for worse, your purchase is going to reflect what the market is performing. And the market has been known to fall drastically during crises. So, of course, during COVID, March 2020, it fell down like crazy. I think it fell like 1,000 points, and I'm talking about the S&P 500. If you need that money in the short term, I think index funds might expose you to a lot of risks that you may not be willing to take. So that's one of the biggest cons. It can fluctuate wildly, and if you need that money in the short term for either retirement to live off of or buying a new house, these are risks to take in mind when you're making that decision whether you want to buy or not. Remember, volatility here is in the short run. So if you don't need that money right away, you can ride these waves. When the market dips low, pretty much the entire market went on sale. That means you could buy things cheaper. And that's a good thing if you're relatively young in your investing career, because these are very rare moments where you can get a good deal on these investments that are going to buy back your freedom from capitalism in the long run. So I think it's every investor has to make their own kind of decision on what portion of their portfolio they want to be reflecting this, but it is a con, and if you can't stomach that volatility, then maybe not put 100% of your investments in index funds. You might put 75% and 30% in cash or real estate. It really just depends on you as an individual. So I think the best way to think about these index funds are as almost like self-cleaning systems. And one of the hardest things I think about the stock market for me growing up was trying to understand, well, you have to buy at the right time and then you have to sell at the right time. And a lot of that requires speculation that I never felt confident enough to exercise. What's great about the index funds is it takes away that excuse, right? Because you don't know what the overall market is going to do at any given time. You just know in the long run it's probably going to grow because smart humans are going to invent amazing things, and they're going to organize capital and produce goods and services for the humanity. So it doesn't require you to time when that's going to occur, because it's always happening. And when you're buying something like the S&P 500 index fund, you're buying those 500 companies, right? So let's say over time, Xerox was at the top, and other companies came and did things better, and there was movement, right? So imagine kind of the list, and then you have Xerox falling down the list over the course of 20 years. And eventually it's removed from the list altogether because other companies have taken its place. But as an investor, you never lost money when Xerox became irrelevant. What happened was other companies came and replaced that market cap in the S&P 500. So it was just continuing to kind of reshape, but ultimately the companies that were delivering the most value kept on getting added, and they keep on growing and becoming bigger. So that's the logic as to why the S&P 500 index fund continues to grow over time, even as companies fail that used to be a part of it or become less relevant. Once again, the thing I like the most about index funds is just the simplicity of it. You just have to buy it. You're making a bet that human ingenuity is going to continue for the foreseeable future, and you don't have to pick who the winner is going to be. You're just making that call of, okay, as long as humans are going to innovate, there's going to be value to be created. The only thing that could throw that for a loop is if there's a nuclear war or maybe actual aliens come and invade us. And if that's the case, then no investment is going to be safe. So it's pretty much one of the easiest things to do, in the sense that you just put it away and then you can focus on everything else. If you like going to the beach, or if you like to travel, or if you like to play music or play video games, you're not having to worry about these little stocks that go up and down as crazy news comes out. You don't have to watch your Amazon performance reports to make sure they're still going to be at the top, because as soon as that tide turns, you need to be able to sell to make sure that you've captured all the value you could from that trade. You don't have to do that when you buy index funds. It's all just happening automatically. So that's one of the main reasons why most of my stuff is just index funds, because I honestly don't want to deal with that. During Berkshire Hathaway's shareholder meeting in 2020, Warren Buffett had said that most Americans should just buy the S&P 500 index fund, and he was going to tell his heirs to do the same. I don't know if you know who Warren Buffett is, but he's one of the greatest investors of our time. And if he's telling his heirs to just do that, and he has no fund manager in mind to kind of take over his legacy, should tell you that maybe if it's good enough for him, it might be good enough for the average person. But I don't know. Obviously, do your own research and make sure that if you do want to buy it, that it fits your goals. So that's all I wanted to say about index funds. They're not complicated investments. They're very simple. In an industry filled with snake oil and a ton of complicated instruments, I try to ignore that. I don't even want to look at it, so that in case I'm tempted to try to speed things up, because honestly, I don't need it, and most people don't. So that's all I wanted to say. Thanks for watching.